Welcome back, focused learners, to another explainer. You know how sometimes you step away for literally just a moment and you come back to find the entire landscape has completely shifted? Well, that is exactly what just happened in the financial technology sector. We're talking about an entire month's worth of wild, industry-shaking news absolutely crammed into just a single week.
Okay, let's dive into this because the sheer density of events here is just staggering. It's like you go on vacation for a week and fintech decides to speed run the entire news cycle. While most of us were just going about our normal routines, massive companies were out there executing aggressive strategic pivots, rolling out some really futuristic AI expansions, and getting tangled up in incredibly messy legal battles.
So, here's our agenda for today's explainer. First up, we've got Robinhood's $2 billion week. Then we'll look at Coinbase's Everything Exchange. And finally, we'll ground ourselves with the dead startups receipts.
All right, Section 1, Robinhood's $2 billion week. Then and out to scale up.
And this brilliantly illustrates the absolute duality of their week. On the one hand, you have a significant headcount reduction. We're talking about cutting roughly 290 employees, which is about 10% of their full-time staff, and taking a $20 million cash charge along with $8 million in stock comp. But then, at the exact same time, they're raising a massive $2 billion in convertible senior notes right as they hit record trading volumes. Talk about moving in two seemingly opposite directions at once.
Now here's a really fascinating detail for you. CEO Vlad Tenev framed this headcount reduction entirely as a culture move, not a cost-cutting measure. And conspicuously absent from his entire memo, the words artificial intelligence. Honestly, think about how incredibly rare that is right now. Almost every tech layoff announcement recently reads like it was written by an AI, blames AI, or is a pivot to AI. Robinhood, they just completely bypassed that whole scapegoat.
As for that massive capital raise, about $300 million of it is specifically allocated for share buybacks. That's to help offset dilution for existing shareholders. They also secured the option to actually upsize the total placement from $2 billion right up to $2.2 billion.
But, the market is going to do what the market does. Despite those planned buybacks to protect shareholders, Robinhood stock slid about 4% anyway. It's essentially Wall Street's Pavlovian reflex at this point. The moment investors hear the words convertible notes, they just instinctively hit the sell button without a second thought.
But make absolutely no mistake, this is not a distress raise. Just consider this figure, $1.07 billion. That was their Q1 2026 revenue, which is already up 15% year over year. They were already seeing record trading volumes across equities and options when these layoffs dropped. They are operating from a position of intense strength here.
Add to that Bernstein's staggering projection for Robinhood's prediction market revenue for 2026, $586 million. To put that into perspective, that represents a massive 286% year-over-year jump. It just adds incredible fuel to an already burning fire of record volume. The big takeaway here is that it's really not a contradiction to cut staff and raise $2 billion simultaneously. As the source beautifully puts it, it's the 2016 Warriors adding KD after going 73-9. Robinhood is already a dominant force, and they're simply building an absolute war chest for whatever comes next.
Let's move to our next story and see how this builds into Section 2, Coinbase's Everything Exchange, building a financial OS.
If Robinhood is scaling up their war chest, Coinbase is out here attempting to become the central operating system for all of finance. During their June 16 system update, they dropped 21 new products. Yes, 21 distinct products hitting the market practically overnight.
So the crucial point is really the headliner of this massive drop, Coinbase Advisor. Listen, this isn't just some basic customer service chatbot. It's an AI-powered investment tool registered simultaneously with top federal regulators as an RIA with the SEC and a CTA with the CFTC and NFA. This is the first in-app AI agent to hold all these heavy-hitting federal credentials at once, carrying a genuine fiduciary duty to act in the best interest of its U.S. Coinbase One subscribers.
And if that wasn't enough, just look at the rest of this manic rapid-fire release list. We've got tokenized U.S. stocks for non-U.S. users, backed one-to-one by actual equities, pre-IPO perpetual futures starting with SpaceX, zero-commission stock and ETF trades, Fannie Mae accepting Bitcoin-backed mortgages, plus they're signing major players like Klarna and Webull for their new custodial infrastructure. It is literally nonstop.
The ambition here is totally explicit. One single account for your crypto, equities,
derivatives, lending, and AI-driven advice. Coinbase isn't just tweaking a roadmap anymore. They've turned the entire concept of the everything exchange into a live product page. They're coming directly for Robinhood, traditional brokerages like Schwab, and standard robo-advisors right now. All right, dropping the energy just a bit for Section 3, the dead startups receipts, the messy plumbing of embedded finance. You know, when high-flying tech ambitions crash into hard reality, the underlying infrastructure gets very ugly very fast. Right now, we're looking at a legal car crash unfolding in New York federal court. Silicon Valley Bank, which is now operating under First Citizens, is suing Patriot Bank, a Connecticut community bank. They're fighting over $21 million in receivables. This cash is tied to Parker, a high-profile Y Combinator-backed startup that issued charge cards for small businesses before it filed for bankruptcy.
Now, what's really interesting about this timeline is how the collapse actually played out, because SVB held a secured interest in Parker's money. Step 1, Parker issues their cards. But at Step 2, Patriot Bank allegedly swept $5.2 million from Parker's accounts entirely unilaterally. Step 3, Parker files for Chapter 7 bankruptcy. And finally, Step 4, SVB sues, arguing that Patriot sweeping those funds was effectively stealing secured collateral right before the whole thing collapsed.
And if you think standard business litigation is just dry, boring paperwork, think again. This battle over embedded finance agreements is incredibly contentious behind closed doors. The judge even reportedly rebuked Patriot's counsel for allegedly threatening criminal liability against SVB's witnesses. I mean, it is a total unmitigated mess, and it highlights a massive risk in embedded finance infrastructure. When the fintech intermediary fails, figuring out who actually owns the underlying funds turns into a complete nightmare.
Which leaves us with this absolutely vital question. As fintech races to build our futuristic financial operating systems, as companies roll out federally registered AI advisors and raise billions in capital, who actually owns the plumbing when it breaks? The Parker mess is a live stress test highlighting the hidden fragility of our modern financial infrastructure. It makes you deeply wonder what happens to all those shiny new features when the startup sitting in the middle suddenly disappears. Something to think about until our next explainer. Keep learning, keep questioning, and we'll see you next time.